Okay, in section 3, we learned a lot. Number 1, the markets are all about liquidity. So what he does, he's using quadrants. He watches the daily chart to find the equilibrium and see where the buying happens in a downtrend. And the inverse, watch equilibrium on the daily chart for selling above equilibrium in a uptrend. On the lower time frames, like an H1 chart, you might be able to see a Wyckoff concept called a spring, and these typically happen around consolidations. And consolidations, which are used by smart money to trap traders, typically they're leading the sheep to the slaughter, as he mentions, and provide liquidity for their own position. So if they want to accumulate, they'll go into a period of consolidation. They'll break down through that period of consolidation on a downtrend, and they'll break upward after consolidation on an uptrend. And that typically will draw in investors who are looking for breakouts in those consolidation periods, and it allows the smart money to go in and sell into those long positions or to buy those short positions. So it's important to wait for price to reveal what the smart money intentions are and to find the next area of liquidity. Those areas of liquidity include the buy stops and the sell stops, and those are very, very important, as we mentioned in the last section. Price consolidating in certain areas gives you clues to future price action. Think like smart money. Where are the buy stops? Where are the sell stops? That's the area that will likely get touched. If you're in an uptrend, where are those stops? If you're in a downtrend, where are those stops likely to be congregating? The trend is your friend, and equilibrium is highly probable target for price to gravitate to, and an excellent level to exit positions, either long or short, along with the smart money. Prices in general, prices of stocks, commodities, and crypto are fractal in nature. In other words, they are self-similar in different time frames. I would add that they are also a result of supply and demand, but on a short-term basis, they're extremely chaotic and they're extremely random. But on a longer time frame, and that's typically why he uses the monthly, the weekly, the dailies, and the 1-hour charts to make his analysis, is that you can see the footprints of supply and demand over time. Fractals do happen in nature, and that's what Fibonacci's are representing. So if you want to do a little research of your own, go to Google, look up Fibonacci, look up fractals, and you'll get a lot of information about why they are important in stock prices and financial asset prices. They are self-similar. So what self-similar means is you can take a look at a monthly chart, you can take a look at a weekly or a daily, and the price action looks pretty much the same. The only difference is the time frame that you're looking in. You have highs, lows, you have moves up, moves down, consolidation periods, and sometimes if you're presented with a chart and you don't know what the time frame is, it could be any one of those time frames in liquid markets. All right, let's go into the next section because this is getting really, really good.